Trump's tariffs torched. Tariffs trumped. The headlines out there, if you've read any sort of financial news or even just national news, you may have seen that the Supreme Court on Friday struck down some of President Trump's signature tariff policies. So here, real quick, we're going to talk about today what was that ruling, how that might impact the economy and the financial markets, and probably most importantly, you're thinking, do I need to care about this in my portfolio? We'll talk through the potential impacts and what actions you may or may not want to be doing with your investment portfolio. So, reading off an article here, so the White House cited a 1977 Emergency Act for its power to impose sweeping tariffs. What happened on Friday was that the Supreme Court ruled 6-3 that this law falls short of granting a president unilateral authority over tariffs, which is a power that the Constitution gives to Congress alone. So what this does is this pulls back a blanket 10% tariff that the Trump administration had placed. And oh, by the way, that tariff had generated a whole bunch of tax revenue for the federal government. So they're citing that there's about $135 billion with a B, $billion worth of taxes that were gathered that's going to somehow get pushed back to these companies. The somehow is really important, and we'll talk about that. Now, politically, this is really just our three branches of government functioning, right? The executive branch is supposed to enact the laws, and the Supreme Court is supposed to check that. So from a political standpoint, that seems like a good, healthy government that's saying, hey, this statute you used, you can't really do that. Now, the executive branch is looking at other ways to impose tariffs with different statutes. So who knows what's going to happen on that front. This can create uncertainty and volatility, or it can create a big fat nothing burger.
Yummy.
So let's just kind of review really quickly. What is a tariff? This is basically a tax on imported goods. So when there are companies that are importing goods into the United States, they have to pay a tax on it. If these companies are refunded some of that tax, well, what are they going to do with it? They're going to do what companies do with excess cash flow. They can lower prices, they could invest in their operations, or in uncertainty, they could just sit on it. Or it could even be such an insignificant amount of money that they just it doesn't matter to the actual operations of the company. And it's only going to be in certain sectors that, of course, input goods. What happens to that money? It's going to go through the court system. So the lower courts are going to actually determine how that money gets refunded and when. They're not really sure even how to get it back. And, I would expect court battles to ensue. So what's going to happen with the markets? Be very careful if anybody on a video or somebody like me that's a certified financial planner, works in the industry, is telling you they know what's going to happen in the markets, because they don't. Here's some things that can happen. Equity markets in the short term are all about what is the value of that company today, what are its current earnings. So that's like reality of the value of that company. And then what's its expected earnings in the future, which is largely speculation based on analysts and what they think is going to happen in the markets. So the valuation of that company is not going to really change at all in the short term, but the speculation forward could change. Now, it's a little bit tricky because if all of the prices in the market have already baked in, Trump, and there's going to be tariffs and there's uncertainty about it, and they may already have that priced into the price. So that's why I said it could be just a big fat nothing burger. As far as large volatility, I wouldn't expect large volatility. Again, I can't tell the future. Every market cycle kind of has headlines that come out, and this time it's different, whether it's a small event or a big event. So a small event might be a headline about something that happens with the Trump administration in the news. That's this one. Or it could be a big event like COVID happened, or a big terrorist attack like 9/11, or the housing market kind of explodes in 2008. These big events, every single time, it's like, no, this is really like the huge event. This is the one that's going to be like the worst crash since the Great Depression. It always happens. And during these time periods, uh, patient investors that have a good investment thesis, like they said, here's where we're going to invest, here's how we're going to react in down markets, are rewarded for following a good, solid strategy. Because what happens is markets adjust and companies adapt. Like during COVID, like really quickly, there were companies that were selling masks, right? In times of war, uncertainty, companies start to change and they sell different types of products. Particularly the United States economy is very dynamic and very adaptable and changes relatively quickly to quote unquote figure it out. So what can we do if there is volatility? So I like to kind of train my clients that I work with. So I help manage their money for them. So I want them to kind of have the right mindset going into this. Is when market volatility happens, ooh, that's cool. What can we take advantage of? There are some things that a good, competent money manager, wealth manager, financial professional can do for you. These are not recommendations for you, but just some things that you may want to consider if volatility does bring equity shares down. Number one, so we're going to do four. Number one is the Roth conversions. So Roth conversion is where you're choosing to pay taxes on your pre-tax money, moving it into a Roth account. If you can do this when the share values are down, right? So share values go down. That's when we decide to do a conversion of the shares from traditional to Roth. And that can reduce the tax costs or allow you to convert more shares. And then when the hypothetical rebound, which has always traditionally happened, that rebound comes in, then you take advantage of that tax-free growth over time. Second one is rebalancing. So as your portfolio grows over time, you may have large U.S. companies, international stock that has made a good, strong run upwards. Rebalancing effectively is selling some of those shares at a higher value and buying into the things that are lower. That's what we want to do. We want to sell when things are higher and buy when things are lower, as well as making sure that the risk is appropriate on your portfolio. Third one, systematic investing. Oh my gosh, I love it when clients are putting $500 a month, $1,000 a month, even small amounts. If they're putting it in on a monthly basis or a regular basis, we can take advantage of these market turns by putting more of their systematic investment into the things that are down at that given time period. You're also doing this if you're investing inside of a 401k. So you're doing draws right out of your paycheck. When the markets are going crazy and oh my gosh, it's going down, it's a good time to take your contribution from 5% of your paycheck to 6, or from 10% to 12. Third thing that you can do when markets are down is do a cash review. So look at the amount of cash you have on hand. If you have a good solid emergency fund, it's maybe a good time to deploy some extra cash into your equity investments. If you're living in retirement and you've set aside some money to keep in place while you're drawing down on those assets, it's always a good idea to look at the amount of cash you have on hand to see if maybe we could strategically pepper in some of that cash into the investments that are down. So in closing, short-term volatility and uncertainty are always going to come. Okay. This specific headline, I don't think is, a life-altering change in your investment strategy. Again, I don't know what the future holds, but it's always important over time. Patient and disciplined investors have typically been rewarded. You look back into the old scriptures inside of the Proverbs, it says that wealth gained hastily will dwindle, but he who gathers it up little by little will increase it. So if we're gathering up our wealth little by little, we're not trying to get rich quick. That tends to reward that patient investor. And if you're working with me or another really good competent professional, we're not building our portfolio around the headlines. Okay, we're building it around your specific values, the things that you think are important to you, and your specific goals. If we're saving for retirement, we're saving for a new big purchase, we're building it specific to you. And so over time, as the markets go up and down, as the rains come and as the disasters come, and as the good times roll around, we're building a plan that's helping you to have wealth with wisdom to really do the things that are most important to you. If you're interested in talking with me more, learning more about my company, and working with a good financial professional, you can go to the website, angellegacyadvisors.com. You can learn more about me. You can set up time if you ever want to visit to learn more about what we do. Thanks so much. Have a great day.